In October 1971, Prime Minister Pierre Trudeau's government declared that decent housing at a reasonable cost was a basic right of Canadian citizenship. Today, that right has become a distant dream for millions. Looking at the raw numbers, the stark reality of a housing crisis becomes clear. In 1984, the average Canadian home cost $76,000. At that time, the average after-tax household income was $48,000. This created a price-to-income ratio of 1.6, meaning it took about 1.5 years of total household income to purchase a home. Fast forward to 2025 and the landscape has dramatically changed. The average home now costs $707,000, with the average household income in Ontario, as per a 2021 census, has only reached $95,000. This has pushed the price-to-income ratio to 7.4, meaning it now takes nearly 7 years of total household income to afford the average home. This represents more than a quadrupling of the housing cost burden on Canadian families over the past 40 years. The price-to-income ratio measures how many years of total household income it would take to purchase a home outright. A higher ratio signals lower affordability. As per Q1 2024 data, among the G7 nations, Canada tops the Housing and Affordability Index at 138. The United States follows at 129, while Japan sits at 112. Germany and the UK hover around 108 and 106 respectively. France maintains a more reasonable 94 on the scale, and Italy shows the best affordability at 85. What does this mean? In Canada, houses cost 38% more relative to income than they did in 2015. We're not just slightly ahead of other developed nations, we are leading by a significant margin. When housing costs exceed a full-time worker's income, we are witnessing a breakdown of basic market functions. To understand how Canada became the G7's least affordable housing market, we need to examine how things got to this point. Right now, Canada has the worst housing supply in the entire G7. We are sitting at 424 homes per 1,000 residents, while other G7 nations average 471. Translation: we are missing 1.8 million homes just to catch up to our peers. Here's where it gets wild. In 2022, Canada added 1 million people, a historic record, but our construction is still stuck in a 1970s time warp. We haven't beaten our 1974 peak when 257,000 new homes were added in a single year. Toronto perfectly illustrates this crisis. It is dead last among major Canadian cities with 360 homes per 1,000 residents. Our population growth quadrupled in a decade, but housing construction flatlined, which is a complete mismatch. The market response was inevitable. Canadian home prices have soared 88% from 2005 to 2020. For perspective, Germany saw a 32% growth, and the US a mere 3% due to the 2008 crisis. Pair this with the 1.8 million home deficit and the math is unambiguous. Canada's housing crisis isn't just about demand, it's a systemic failure to build at scale, which is needed for the population. Let's spend some time understanding why our housing supply is the way it is. The latest CMHC data tells a troubling story. Starting with the big picture, housing starts or new construction dropped from 271,000 to 249,000 in just 1 year. But that number hides the real crisis beneath. Let's break it down by housing type. Housing starts for single detached homes show a 20% decline between 2022 and 2023. This decline means a lesser number of homes began construction in 2023 than in 2022. It shows a steady downward trend over the last 20 years. For semi-detached homes, this number declined by 12%. For townhouses, we observed a 10% decline. For apartments, we saw new construction increase by 7%. Declining housing constructs is not a new problem, and this is something which has been happening for the last 20 years. Now let's understand what's driving this decline. There are several factors at play here. First, construction costs are soaring. Rising interest rates have hit hard. The Bank of Canada's policy rates jumped from near zero to over 5% in the last few years, making construction financing much more expensive. Add to that labor shortages, material costs, and supply chain issues, which are all pushing the price up. Second, the completion timeline across cities tells an even grimmer story. In Toronto, there is a 32-month wait for approvals. Milton and Whitby are the speed champions, getting approvals done in 10 to 13 minutes. But the average approval timeframe across the GTA is now around 21 months, and approvals in some municipalities stretch to 34 months. Every month of delay adds up to $2,600 in cost to an 800 square foot apartment. Multiply that by 30 plus months of waiting and larger properties, and you see why projects are being cancelled all across the Ontario province. Adding to the cost are municipal fees, which are out of control. A study completed in 2022 showed that these fees have shot up by more than 30%. That means tens of thousands in extra costs piled onto new homes. The study tells a stark story. In most cities which were studied, building a simple house or townhouse means paying over $100,000 per unit just in government charges. Nearly half the municipalities studied go even further, demanding more than $125,000 per unit. The trend lines are clear. Total housing starts are declining, major markets are building less, population growth is continuing upward, approval times are getting longer, costs are rising steadily. This is Canada's housing reality in 2025. Building less when we need more, waiting longer when we need speed, and falling behind when we need to catch up. Talking about investment, Canada's real estate market has seen a sharp increase in the involvement of both domestic and international investors. Investors ranging from individual property owners to large institutional entities are capturing a significant share of housing, particularly in the urban centers like Toronto, Vancouver, and Montreal. Here's what the data reveals. Major American investment firms are pouring billions into Canadian real estate. Firms like Hines and Blackstone are leading this trend. Hines is a US-based real estate giant with plans to invest $2 billion in rental housing developments, focusing on cities such as Toronto, Vancouver, and Montreal. They already manage $3.7 billion in Canadian assets with a mix of commercial and residential projects. Blackstone, on the other hand, is the world's largest private equity firm with $1 trillion in global assets under management. They currently have over $20 billion in Canadian real estate holdings. This investment is concentrated in industrial, logistical, and multifamily sectors. Canada is its third largest market globally after US and the UK. According to Statistics Canada, more than 1 in 5 property owners across Ontario, British Columbia, Manitoba, New Brunswick, and Nova Scotia were classified as investors in 2020. Nova Scotia has the highest proportion of investors at 31.5%, New Brunswick is at 29%, British Columbia is at 23%, and Ontario has 20% investor share. Investors in these provinces often focus on condominium apartments, with 41.9% of condos in Ontario owned by investors, the highest rate in Canada. Housing is being treated as a financial asset rather than a place to live. Over the past decade, investor ownership has driven up housing prices, crowding out first-time buyers. Wealthy investors and institutional landlords have acquired large shares of housing stock, including older rental buildings, often displacing lower income tenants. In some cities, investors are capturing the majority of new builds. In Ontario, 57% of newly built condos between 2016 and 2021 were investor-owned. In British Columbia, investors owned 49% of the newly built condos during the same period. Let's talk about why millennials are finding it impossible to buy a home in Canada. Housing prices are through the roof, yes, but there's a deeper issue at play: debt. And it's hitting us on two levels: government debt and household debt. Let me break this down. Canada's national debt has exploded. By the end of 2024 to the beginning of 2025, our total market debt was projected to hit $1.4 trillion. Every day, that debt grows by $100 million, and you're paying a staggering $75 million daily in interest alone. That's $27 billion a year, money that could be used for affordable housing programs, infrastructure, or reducing the tax burden on Canadians. But instead, huge portions of government revenue are funneled into servicing this debt. This leaves less for investments that actually help families or first-time buyers. Millennials already struggling with housing costs are seeing fewer programs and supports because the government simply does not have the funds. Let's zoom into personal finances. Canadian households now have the highest debt-to-income ratio in the G7 at 185%. That means for every dollar of disposable income, Canadians owe $1.85. Compare that to the G7 average of 125%, and you see how severe the problem has become. For millennials, this debt is suffocating. In 2023, millennials spent 10 cents of every dollar earned on interest payments alone, up from 7 cents in 2022. That's just the interest, not even touching the principal portion of a debt. Now let's talk about savings. Canada's saving rate has plummeted. In the 1990s, Canadians saved 7.8% of their income. By the 2010s, that dropped to 3.6%. Today, it's 1.9%. For millennials trying to save for a down payment, this is a disaster. Let's put this into perspective. A minimum down payment for a $750,000 home is $50,000. At today's saving rates, it would take over 13 years to save that amount, and that's if you could save every penny you earn. For most millennials, that's impossible. Here's how the debt connects to housing crisis. Government debt crowds out investments. With so much money going towards interest payments, there's little left for affordable housing programs or infrastructure that could help support more development. Household debt eats into buying power. High debt loads and rising interest rates mean millennials have less disposable income for housing. Any rising borrowing costs make home ownership even further out of reach. With inflation and debt eating away at incomes, millennials can't save enough for down payments. The saving crisis compounds the affordability crisis. Canada's housing market is broken, and millennials are bearing the brunt of the crisis. But the solutions are clear, and they are within reach if we choose to act. First, we need to build more homes and build them faster. Canada needs 1.8 million additional homes just to catch up to the G7 average, and we're not even building enough to keep up with the population growth. Fixing this starts with streamlining approvals. In Toronto, the average approval process time should be cut down to 6 to 12 months at least. On top of that, reducing municipal fees, which currently add $100,000 to $125,000 per unit in Ontario. This could make housing projects more viable and ease costs for buyers. Investors currently own 57% of Ontario's newly built condos, making Canada's housing a financial asset rather than a place to live. Policies like higher taxes on speculative purchases, short-term flips, caps on corporate ownership, and restrictions on non-resident buyers would be welcome, especially in high-demand markets like Toronto and Vancouver. Finally, millennials can save enough for down payments while juggling high rents and rising living costs. Programs that encourage saving through matching contributions or tax-free savings accounts specifically for home purchases are essential to getting younger Canadians back on track towards home ownership. These changes won't be easy, but they're necessary if we want to give millennials and future generations a real shot at home ownership. The question now isn't whether we can fix Canada's housing crisis. It's whether we have the political will to make it happen.